Hello, everyone. This is Kripa Anand, and welcome to the Canadian SME Small Business Podcast. Today, we are breaking down the operational mechanics of real startup growth. In 2026, building a sustainable business isn't about chasing venture capital hype or scoring high valuations. It's about establishing structural foundations that allow a company to survive its own success. Joining us today is Elizabeth Thorsen, owner and principal at Elle Thorsen Consulting. Based in Vancouver, Elizabeth is an elite startup operator, advisor, and ecosystem mentor with over 15 years of experience across Canada's tech, climate, and innovation spaces. She specializes in moving founders out of reactive chaos into execution readiness, ensuring they scale with absolute structure and clarity. So, before further ado, let's welcome this very special guest. Elizabeth, welcome to the podcast. Such a pleasure to have you with us.
Thank you, Kripa. It's a delight to be here today.
Now, Elizabeth, you frequently emphasize that a massive difference exists between building a business that looks great to investors and one that can actually survive scale. So let's start the conversation from this point. What is the difference between a fundable startup and a scalable business? Go ahead.
That's a great question and a really common misconception that fundable and scalable are the same thing. Often, a fundable company is a scalable company and vice versa, but not always. I think at its core, a fundable company is really one that can convince investors that there's potential for outsized returns. Investors are looking for a large market, a compelling story, defensible technology or IP, and a path to exponential growth, oftentimes a path to 10x returns or more. But that return could be through M&A versus IPO. A scalable business is operationally capable of growing without costs increasing at the same rate as revenue. In fact, costs should be decreasing as you find those economies of scale.
Mhm.
Scalable businesses have, repeatable systems, strong leadership, documented processes, and an economic model that works at 10 customers or 10,000 customers. So it means either growing the product line, the customer base, the geography of your sales doesn't always require that you have investment to do so. Bootstrapping can be a really viable approach depending on the sector and, of course, the path to market. In my experience, I've seen a lot of startups become fundable before they're scalable. They
Mhm.
raise money because the vision or the end goal is exciting, but they haven't necessarily built the operational foundation that they need to support that rapid growth. And this is especially true when you look at sectors like deep tech, clean tech, biotech. It can be a really long pathway to market, but the business has barely shown a proof of concept or a prototype, let alone, a finalized proven business model.
Mhm.
The value of the moonshot is what can make it worth it to an investor, or the value of the IP in the company. It doesn't matter if it's a scalable venture at that point. You're investing in what you believe to be an appreciating asset, for lack of a better way to explain it.
Right.
Neither are necessarily a wrong approach. You can scale, you can fundraise, you can do both, but ultimately it's about what the founder wants. Are they a builder? Are they a scaler? Do they want to be a CEO at scale, or do they want to exit and start again? And so the founders who succeed at growing and scaling ventures, they're the ones that spend as much time building the business as they do selling that dream. The founders who succeed at fundraising are the ones who are clear on the vision, the traction, and the potential of the business, and that convinced investors to take the leap with them.
Wow, I loved how you articulated that. Uh, what you said, prioritizing internal system design over vanity investor metrics, it ensures that your operations can handle a sudden influx of market demand as well. And with this clarity, uh, startups are often looking for fundraising, right? But they don't know how to handle that. So let's explore why startups often struggle after early funding success. So, from your extensive experience, I'm sure you've talked to so many people. Why do many startups struggle after raising their first major funding round? Is it more of a mindset issue, or do they take a series of wrong decisions that, later come and haunt them back? So, what is it?
I think yes, it could be either, it could be both.
Yeah.
Funding, I think there's this idea that funding is for everyone, and it's really not. Sometimes founders get into this trap of, what they consider to be like the gold star startup. So if you think, you have an idea, you build a prototype, you raise a bunch of capital, you scale the business, that's the Silicon Valley view that we've all been sold. And in reality, after you've exhausted, grants, non-dilutive capital, the first equity funding round can actually create pressure rather than solving problems for some businesses. So suddenly founders are in this position where they're expected to hire quickly, to grow aggressively, to report to investors, to hit ambitious milestones, and to manage a much larger organization than they had before, or maybe than they have ever. And the reality for founders, especially first-time founders, they've never managed a 20-person company before. 6 months ago, they were managing, 3 people or maybe just themselves. So money can be a fantastic enabler of growth, but it also can magnify existing business weaknesses. If your systems aren't there, they break. If your leadership isn't aligned, you get conflict. If you don't have a strong culture or HR strategy, you get the wrong folks in, and it can be really costly to solve some of these problems later on. The second problem
Definitely. Right.
is you also get into this like growth at all costs mindset. I'm sure lots of folks who are listening have experienced this as customers.
Yeah.
Startups launch, they have this incredible product, it's affordable, customer focused, it solves a real problem, and that's how you win early adoption. But after a big funding round, that's when the expectations change. So investors now want rapid revenue growth, margin improvement. Suddenly, features that were free are now paid tiers. Advertising starts to creep into the experience. Your customer support becomes automated. Your subscription prices increase. And so the company starts optimizing for those quarterly numbers rather than optimizing for long-term customer loyalty. And I think you know what I mean. We've all had experience like this, especially with software as a service.
Hmm.
It's what we call in the industry inshitification. The product gets incrementally worse because the
Yeah.
incentives have changed. And founders, they're not bad people, neither are investors, but they're responding to pressure from a business model that demands ever increasing returns. And so the irony of this is that can undermine the very thing that made the company successful in the first place. That's when
Right.
you see things like customer trust eroding, churn increasing, customer acquisition costs climbing. And so the founders who navigate this really well are the ones that remember that investors are important stakeholders, but customers are the ones who build the business. And the founders who survive are the ones who slow down enough to make sure that they have the right operating system behind the business, not just the product that they're selling. It's really difficult when you're in that execution mode, that growth mode, to make the conscious choice to move slow, but it's sort of akin to the analogy of the tortoise and the hare, slow
Hmm.
and steady, planned growth. That's what's going to win. And that's sort of why a lot of startups, have challenges after they've raised that round, is because they go into fast growth versus
Uh-huh.
planned growth.
Definitely, this is incredibly helpful because it comes from all the candid experiences that you've accumulated over the years, and I loved what you said about the focus being on the operational and the execution part of it, because shifting your posture from reactive day-to-day firefighting to structured, repeatable systems is. At the end of the day, what prevents a well-funded team from burning through their runway. So, thank you for those insights. Next, let's look at the ongoing venture capital gap specifically for women-led businesses. So, I'm very closely associated to women-led businesses as well. But from your perspective, I'd love to understand, Elizabeth, why do women-led startups still receive such a small share of VC funding? What's the reason according to you?
I mean, there's so many people who are much more experienced than I have all these different theories, but this is one of my biggest frustrations, full stop. Women-led ventures raise less than 10% of the global startup funding.
Right.
Mixed gender teams receive less than 15% of global startup funding. Do you want to guess the percentage of capital that all male founder teams raise?
It should be more than 70%.
Yeah, it's more than 80%.
Oh,
And
see,
I know
yeah.
that there have been some improvements. This is coming right from PitchBook, but this gap has persisted since basically the 1980s and even earlier. It hasn't even meaningfully changed. Although there
Mhm.
have been some improvements, it's incremental change. It's a complicated issue, but I think it comes down to networks, to pattern recognition, and to perception. Typically, investors have funded founders who look like the founders they've backed before. And that's part of the reason why historically it's easier for serial founders to raise capital. Much of early stage investing is pattern recognition. You look for
Mhm.
success that looks like previous examples of success. But that also creates some unconscious bias and limits access to capital for women and for other traditionally underrepresented entrepreneurs. Women also, they tend to be a little over mentored and underfunded. What I mean by that is they get lots of advice, but traditionally and even now, they have fewer opportunities to access networks where investment decisions actually happen. And I don't want to minimize the contribution of new investment groups that are targeting women-led ventures directly.
Mhm.
There's there's SheEO, the 51, BDC has their Thrive initiative for women, just to name a couple. So there are definitely steps in the right direction, but statistically, this gap still persists. And at the same time, this blew my mind. Um, Women often build businesses differently. So, according to First Round Capital's 10-year report on gender diversity and startup performance, investments in companies with at least one female founder performed 63% better than investments in all male founding teams. And Boston Consulting Group showed that women led ventures delivered 10% higher cumulative revenue over 5 years while getting 50% less capital in their study. So, a lot of these businesses show that they perform better, but they don't always fit that traditional venture model. So, what I want to see, hopefully, is the conversation shifting away from asking why women don't receive that funding to asking whether our funding systems are rewarding the right kinds of companies. I'm privileged. I get to work primarily with women led ventures, BIPOC led ventures. Anecdotally, I am seeing change. There are lots of great folks working really hard to continue pushing along that change, making sure that more capital flows into well-deserving companies, regardless of what their foundership team looks like. And I'm hopeful in 5 years, 10 years from now, we're going to see some different numbers. But for now, I think it's an entire ecosystem responsibility. We all need to lean in and either contribute our time, open our networks, or even invest directly into women-led ventures if we want to see the needle move.
Definitely, that was a very 360-degree kind of an approach to the question. All I'll say about this is I agree with whatever you've said. And women right now, I'm glad to say that that shift is slowly happening, but at a very slow pace, right? Women
Mhm.
right now have stopped asking for a seat at the table as well. They're right now building their own tables, right? So, building on what you've said, here's a special message right now for all the founders and specifically the tech innovators who are listening and watching. In 2026, building an investment ready business requires a calculated strategic blueprint. Elizabeth Thorsen is at the absolute forefront of this movement, having recently emceed the Global AI Summit and led vital scaling discussions at Climate Global. Through Elle Thorsen Consulting, she provides early and growth stage companies with the precise operational structure, facilitation, and fundraising preparation needed to scale at high speed with total confidence. So, if you are ready to stop relying on early stage hype and start building a resilient enterprise, please visit ellthorsen.com today. Don't just look for capital, build an unstoppable business model. Coming back to you, Elizabeth, leaving women-led ventures undercapitalized is no longer just an equity challenge. It is a massive missed economic return for the entire Canadian venture ecosystem. So thank you so much for that great reminder. Next, let's explore strengthening Canada's innovation and startup ecosystems. So, again, from your perspective, Elizabeth, what is missing from Canada's startup and accelerator ecosystem in today's time?
That is another great question. I think we have all the right pieces. It's just how we put them together. Canada
Mhm.
has incredible talent. We have world-class research institutions. We don't have a shortage of innovation. Where we tend to fall a little short is around commercialization support and scale-up expertise. We've got really strong at helping founders start companies through incubators, accelerators, early stage programs. I've spent a lot of my career working with accelerators across the country, and what I've seen is that the gap shows up after that early stage. We're really great at getting companies from 0 to 1, but less consistent at helping them go from 20 employees to 200. That's partly a function of our ecosystem maturity and partly a reflection of scale. We operate in Canada on a fundamentally different environment than our neighbors to the south. We have a smaller population, smaller capital base, and by extension, fewer companies that can reach outcomes like unicorn status or IPO. In Canada right now, we have about 20 to 25 unicorns, so companies that are valued at $1 billion or more. Compare that to the US, there are an estimated 850 to 1,000 unicorns. So that gap is significant. And it's not reflective of a lack of talent or ambition. It's reflective of a thinner density of lived experience at the top end of that scale. Fewer companies reaching, 100 million, $1 billion in sales naturally means fewer people who have navigated those journeys right through to the end. Fewer IPO lawyers, fewer operators who have led at that hyper growth stage, fewer founders and CEOs who have built and exited at that level. It's a systemic issue, but I want to see it as a systemic opportunity. These people exist in Canada, they're incredibly valuable, but they are so limited in number and they're so dispersed across our huge geography. Then you see in the States where you've got concentrations in places like New York and Silicon Valley and Boston. Uh, Experienced operators play such a critical role in our ecosystem, not just as advisors, but folks who have been there, who have done that. And so I think when we look at we don't have a startup problem, we have that scale up problem, and it's going to take a lot of upscaling to address. It is already in progress. I had a chance to attend a 2 day intensive about a year ago on scaling that was led by an international group. And we've got lots of great founders here that are working to create incubators to translate their lived experience. If you look at a couple of examples from our backyard in British Columbia, Canada, Smart Sweets founder Tara Bosch started her company in 2015, launched shortly thereafter with a healthier snack option, sold in 2020 for, I think it was mid 9 figures. And then in 2023, she started Bold Beginnings to support women entrepreneurs under 30 in building scalable ventures. So that knowledge transfer. Same thing with Charles Chang, founded Vega, the plant protein company that sold for, I think, something like 550 million USD back in 2015. Then endowed SFU to support the Charles Chang Institute for Entrepreneurship and works as a mentor and investor in the ecosystem. This is the type of experience transfer we need if we want to grow. We ask a lot of our successful exited founders because we don't have a ton of them to call on, but the ones who have
Yeah.
done it do really seem to be leaning in and helping that next generation of Canadian ventures to reach their potential.
Beautiful. Great examples there. And re-engineering programs to focus on structural execution readiness rather than just, pitch deck perfection is what builds
Absolutely.
companies that are truly built to last, right? So great conversation. But this is incomplete without the mention of artificial intelligence, right? Specifically when we talk about a future in which we are talking about responsibility and sustainability as well. So from that perspective now, Elizabeth, how can businesses adopt AI while maintaining sustainability and also community impact?
Well, AI and responsible growth from a sustainability perspective can feel like a bit of an oxymoron. I mean, AI
Yeah,
is inherently, it's energy, it's water intensive.
right.
So there's that tension always between its expansion and the traditional definition of, environmental sustainability.
Yeah.
I don't think that contradiction is going to go away, but if we broaden the lens of sustainability beyond climate impact to include business practice sustainability, productivity, long-term organizational health, I think then the conversation becomes a bit more approachable. So, in that context, AI should be seen as a force that augments people rather than replaces people. And
Mhm.
the most effective organizations that I've seen and that I've worked with are using it to remove repetitive work, improve decision making by providing information, and free up human capacity for creativity, relationship building, strategy. It's great to get the ball rolling in some ways on, ideation or templating, proofing emails, highly administrative, time sucking tasks. That's where it can really optimize the business. But responsible adoption also means being really intentional about some of those second order effects,
Mhm.
environmental impact, of course, but data privacy, transparency, and how workforces transition as roles evolve with AI-enabled technology. Tech has always shaped jobs, but companies that invest in retraining and redeploying their people to build stronger cultures, more resilient businesses over time, those are the ones that are succeeding. AI has this tremendous opportunity, or we have this tremendous opportunity to leverage AI to level the playing field by giving small companies and nonprofits access to capabilities that previously were only accessible to large organizations that had significant capital resources. But the question now is not inherently, should we adopt AI? Is it sustainable? It's already here. You see from search engines to coders to agentic bots, they cover a range of tasks previously done by humans. And now it's about how we adopt it in a way that balances trade-offs and makes sure that benefits are distributed rather than concentrated. Um, We've all heard about AI agents going rogue, deleting code bases for tech companies,
Right.
or releasing private customer information. It can be scary. And I think it really underlines the ongoing need for skilled professionals to oversee AI. It's like hiring a new employee. You have to train them, you have to supervise them, you have to give them coaching. You would never bring a new employee who's really junior and untested onto the team and
Yeah.
ask them to present to your biggest customer without doing a dry run and looking at their deck first. And you shouldn't entrust AI to build your product without a really seasoned developer that's overseeing and checking it, building those guardrails. AI is a great way to minimize costs. It is not a replacement for human expertise at this stage. It is an augmentation that's meant to support us. And if we see it that way as a tool rather than as a solution, we can build it in responsibly and sustainably to workflows and to operations.
Amazing. Again, I love how you articulate your answers because, when we talk about the future, there's also this responsibility of the next generation that we are catering to, right? So,
Mhm.
uh, I think we'll need to do another episode and hopefully in person to go over, so many things that I am still, yearning to learn and discuss with you. But for now, today, Elizabeth, before we finally let you go, if there's one final piece of advice that you'd like to leave with our listeners today, something for the founders who are trying to become investment ready, but don't know where to take that first leap of faith or hope from, if you could whisper one thing into their ears, what would you say and why?
Yeah, well, I mean, first I would tell them to take a really serious look about whether they need to raise capital. If that's the right path for them,
Yeah.
then I think my advice would be to stop focusing on raising money as an outcome and start focusing on building a company worth investing in. Investors invest in traction, execution, teams more than they invest in ideas. So it's so important to know your numbers, understand your customer acquisition costs, your unit economics, have a really clear strategy, build a leadership team that complements your strengths and fills those skill and knowledge gaps. Demonstrate that customers are willing to pay for what you're selling. That's the most important thing. And really remember that venture capital isn't the right path for every business. Some of the strongest companies I've worked with grew through customers and bootstrapping rather than than investors, excuse me. So things like non-dilutive financing, traditional banking services, they can let you maintain more control over your company and over your model, making for
Mhm.
a better profitable exit long term. But sometimes it's just not possible to grow that to scale or exit unless you get that catalytic capital. And so at the end of the day, investment readiness, it's just business readiness. And if your business foundations and fundamentals are strong, then funding becomes a much easier conversation.
Indeed, another great reminder that establishing clarity within your internal team must happen before you ever step into an investor boardroom, right? Elizabeth, it was such a great conversation. Thank you so much for being here and doing this for us.
Thank you, Kripa. It's a delight to be here.
All right, that was Elizabeth Thorsen from Elle Thorsen Consulting, a masterclass in building truly scalable businesses, overcoming the operational hype gap, and understanding the real economic potential of a fully optimized Canadian innovation ecosystem in 2026. To all the listeners, thank you so much for tuning in to the Canadian SME Small Business Podcast. Be sure to subscribe and visit CanadianSME.ca for more such resources. To learn more about how we are supporting the ecosystem, please visit the Canadian SME Small Business Foundation at smbfoundation.ca. And lastly, a very special thank you to our partners, UPS, our shipping partner, and ADP, our HR partner, for their ongoing commitment to empowering SMBs across Canada. I'll see you all in the next episode. Kripa Anand signing off.